Okay. Hello, everyone. Welcome to day 3 of the SHOF-ECGI Conference on Sustainable Finance and Corporate Governance. My name is Dong Yan, and I'm a faculty member here at the Swedish House of Finance at the Stockholm School of Economics. I will be moderating the sessions today. We have 4 very interesting papers, followed by a keynote speech by Harrison Hom. Before we start, let me quickly remind you about the ground rules for the session. So each presenter has 30 minutes. Each discussant has 10 minutes, except for Jang, who will discuss 2 papers in 15 minutes. So the remaining 5 minutes will go to the presenter for responses. And if we have time left, we'll take some questions from the audience. So there is a Q&A function in Zoom, so please use that to add your questions for the speakers. Lastly, the keynote speech is 40 minutes. So I will interrupt everyone to remind the presenters about time. I apologize for that in advance. All right, thank you everyone. And I hand over to our first presenter, Itzhak Ben-David from Ohio State. He will talk to us about exporting pollution. Where do multinational firms emit CO2? Itzhak, the floor is yours.
All right, thank you so much. It's early morning here on a Sunday in Columbus, Ohio. So greetings to everybody. Okay, so our paper is called Exporting Pollution. Where do multinational firms emit CO2? And this is joint work with Yeejin Jang, who is currently in the audience, I believe. Stefanie might be also here, and Michael Viehs from Erasmus and Oxford. All right, and I should mention also that the views here are not reflecting Michael's employer, which is a Hermes investment company. All right, so let me just jump in. I should share my screen, I guess. It's early in Ohio, as I said. All right, so let me see whether this works. Works? You guys see? All right, fantastic. Perfect. So just take a moment to be impressed by the background here. All right. Okay. So the paper is about carbon leakage by multinational firms. So just to kind of set the stage a bit, different countries have different environmental policies. And what we will be interested in doing here is looking at firms that are multinational, meaning that they have operations across different countries, and explore where their CO2 emissions are. Now, why multinationals? Well, multinationals are the largest economic players in terms of corporations. If you look at, just as an example, in 2017, 50% of the cross-border investment by multinationals was about 50% of GDP of OECD countries. So this is substantial. They also have existing infrastructure, so responding could be just easier for them. You know, if you're just a local firm, you know, doing something with your pollution activities is more difficult. For them, it's easier to shift if they wanted to shift activities. It's cheaper. And finally, their activities are easy to observe. These are oftentimes, or most times, public companies. They report their emissions, as I will discuss in a few moments. Now, so what do we going more deeply into the paper? We're going to use a novel panel data set that reports at the level of firm, country, year their CO2 emissions. So for each country, think about a country that works in firm that operate in 10 different countries. We will know in each country how much they emit, and also the emission is going to be, the CO2 emission is going to be on several categories, as I will discuss in a few moments. And basically, we'll try to answer how important are the home versus foreign environmental policies. Now, I'll preempt some of my discussants' comments right off the bat. This is not about randomized experiment or any clever identification in terms of a rule change, or we're going to have just slightly flavor of this, but it's going to be more a broad brush mapping. I mean, when we got access to the data, we kind of said, sometimes, when you look at these rule changes, you see kind of maybe the trees, but you don't see the wood. And we were interested in kind of just broad brush mapping, just, is there any correlation, or are they just to understand where the big picture in pollution? Maybe we could say something as economists there. So just to kind of what we're going to look at, we're going to look at the push versus pull. This is going to be, I think, one of the more interesting results here in terms of our is stricter environmental policy at home pushes you away, or are there like enticing countries that you want to emit there, and their lax environmental policy actually pull you to their country? So we'll talk about supply chains, and maybe we'll be able to say something about corporate governance and industry characteristics. But as you will see, there are a few caveats there. All right. So just to kind of quickly summarize the findings, I think that there is substantial evidence of carbon leakage, meaning that firms that are headquarters in countries with strict policies actually pollute less at home, at their home country, more abroad. And there is also outsourcing. There is evidence, and again, it's going to be a bit caveated, but there is evidence of outsourcing polluting activities along the upstream, basically to suppliers. And pollution abroad, exporting pollution, is going to be higher when there is a bigger environmental policy gap between the home country and the foreign country. We also find that when you have a stricter domestic environmental policy, firms pollute less in total, but this effect seems to be kind of minor, and again, it's going to be a bit caveated, this result. We'll talk about push versus pull. So strict domestic policies seem to push away pollution to other countries, as opposed to kind of pulling by foreign countries. If you think about third world countries, it's not. We don't see a lot of pulling by offering convenient policies for pollution, but rather it's the home country that push about. And finally, there might be some association, again, going to be caveated with about governance and pollution-intensive industries. But I should say, we don't find material results for pollution-intensive industries. Okay, let me start with the data. So we're going to have emission data per firm, per country, per year on 3 levels, or actually 2 levels, and the third one is going to be moment. But the 2 levels are scope 1 and scope 2. Scope 1 are basically emissions being used directly by the firm. So the firm has manufacturing facilities. How much do they emit straight from these facilities? It includes also travel. It includes also any activities that the firm does. Scope 2 is the emission being done by the electrical and heating companies. If they use some third-party, well, most firms use third-party electricity, how much emission is done in this process. So these are kind of indirect energy being used to pollution that was done during this electricity. So it's going to be, for example, different firms will report different emissions if they used electricity coming from solar and wind power as opposed to fossil fuel, depending on their electricity supplier. And finally, so these two are going to be at the firm, country, year level. Finally, we know also for some of the firms, for about 40% of the firms, for a subset of the years, we have information about scope 3. Scope 3 is kind of going beyond it. It's basically about the inputs, about the emissions that were used in your inputs, about business travel, it's about commute, all these kind of even more remote activities. We have information there only at the global level. So for each firm, we will know, so say Apple, we will know what's the total amount that they emitted in scope 3 in a particular year, but not broken down by country. All right, so the data comes from a CDP carbon disclosure project. So these are basically voluntary questionnaires that are being sent to public firms. And the reason that public firms spend time and money responding to these and they try to make it accurate is because these are used by institutional investors. And the CDP database is basically makes its living from selling this data to institutional investors who care about ESG. Some of the data is actually audited, and we have, as part of our robustness, we just run the main results for the audited subsample, and the results are very similar. Okay, so we have emissions to nearly 2,000 public firms across the globe. They are headquartered in 48 home countries, and they operate in over 200 foreign countries. Specific, my daughter yells there. אמא לא בבית. היא הלכה the survey, the years for the survey are 2008 to 2015. And we have information at the firm, country, year, as I mentioned, for scope 1 and scope 2. For about 40%, we have information for scope 3 at the global level, firm year, but only for 5 years. Now, there is another issue with scope 3. Scope 3 is less standardized, so firms seem to kind of include different things sometimes in scope 3. So the result that I'll show you with scope 3 have this caveat that we feel less confident about them, but you know, this is the best we have. So this is one kind of important data set that we use. The second component is the environmental regulation index that comes from the World Economic Forum. And basically it has two components. One is about stringency of environmental policies. And the second one is enforcement. We combine these both, and they are highly correlated, as you can imagine. We combine them to a single score, which we call SEER. As an acronym, and basically higher means stricter. So both, it's going to be a multiplication of these two individual scores. And just to get a kind of an idea about how the data looks, what you see here on the right are basically the average fraction of, this is kind of like our main result, the average fraction of foreign emissions out of your global global emissions per country as a function of CR. So what you could see is that on the left you have the low environmental policies. Firms that are headquarters in Russia, India, Turkey, China, Colombia, Thailand, etc., are emit pollution, emit CO2 more at home as opposed to abroad. As you move to the right, you get to the more OECD countries. You know, we can see there Japan, New Zealand, Finland, Germany. The US is also somewhere here. US is 4 only. So for these countries, they emit more abroad. Now, obviously, this is just just summary statistic. In our regressions, we have controls for the for GDP, etc. I'll tell in a few moments, but the its relationship actually is conserved in regressions. I'm not sure whether this slide is optimistic or not. If you look at the difference in our environmental regulation score between 2008 and 2015, you know, it's changed, but a bit. Okay. All right. So our first set of results, basically looking at you know, basically the relation that I showed you in this chart. If we look at how much you emit, we're going to have different categories as you'll see in a moment. How much you emit as a function of your environmental regulation score at your home country. What we find is that firms that are headquartered in countries with strict environmental policy emit about 20% less, both Scope 1 and Scope 2. They emit much more, the effect is much larger, meaning they emit much less in their home countries, but emit much more in foreign countries. This is basically what you've seen in the univariate chart before. Okay. Now there are controls in the background. So basically, we control for the firm's size, the foreign asset shares in some of the. This variable is a bit missing, so in some of the regressions and some country home country variables like the GDP and GDP for per capita growth. There are also industry and times year. Then we look at global emissions. So the question we're trying to ask here is whether there is an association between the environmental policies at home and your overall global emissions. And we find that firms that are well, actually, I showed you already that global emissions are lower by 20%. Sorry, it's too early here in columns higher. So we'll try to ask the following question here in this analysis. We know what happens in Scope 1, Scope 2 that are kind of under the control. Scope 1 is directly under the control of the firm. Scope 2 is more is a direct input in a way, electricity, right? Scope 3 is about your suppliers, your business travel, or things that are kind of more remote. You have discretion, but it's somebody else is who pollutes. May not be under if I buy some inputs coming from a different country, it's not. Even if in my country there is a strict environmental policy, it's not going to be taken against by my own company. So the question is, what we're trying to ask is, do firms in strict countries with strict environmental policies outsource more these kind of activities? So as I told you before, scope 3 is available only at the global level and only for some of the firms. So the first thing that we do is we just repeat our earlier global emissions regression for this subset of firms for this subset of years. And what we find is that this is what you see here in the first column. For this subset of firms, they use less of scope 1 emissions, about 24%. Before it was 20%. So they emit less at home. Now the question is, do they substitute along the supply chain? So we look at scope 3, and there is a positive yet insignificant effect of substituting away. So they use slightly statistically indistinguishable than zero more pollution along the supply chain. When we combine scope 1 and scope 3, kind of asking, okay, overall, do they substitute their own activities with scope 3? We find that the global emissions for these firms is actually halved than what we would estimate or what would look like if we just looked at their direct activities. So it seems that there is a bit of pushing some of your emission or towards firms upstream the supply chain. Okay, so we try to take advantage of the fact that we see where they emit. So we're going to look at the gap between the environmental policies at home versus the entire globe or all other countries. So we're going to ask, are you going to emit more in abroad when the policy gap is bigger? And this is what we find. We find that firms are more likely to emit in foreign countries when the gap, the policy gap between the home and the foreign country is larger. We talk about a couple of economic mechanisms. The first one that I think is the most interesting and important is the push versus pull. So if you think about so far I've shown you associations, right? I mean, these were correlations. There is a good reason that there are some omitted variables that we haven't controlled for, and that's the nature of the data. Right, so these are associations. The question is, can we say a bit more about whether whether countries actually push firms out by? Is it the strict policy in the home country that pushes firms to pollute out, or are these foreign countries that actually pool, provide convenient environmental policies so that firms come to them, right? And you have in the environmental economic literature, the theoretical one, you have proposal for both mechanisms. So what we're going to do here is to use the Khawaja and Mian 2008 framework. So the idea is that because we have this interesting data structure of term, country, year, we can actually try and control for basically hold constant the policies of my my home country per year, and ask, does the variation in foreign countries' policies matter for firms headquartered in my year, and vice versa for the foreign firms. So let me just show the results, and hopefully it will be clearer. So what we're asking here, we're looking at the push effect. Do firms actually, do countries push away domestic firms to pollute elsewhere. And so here's what we do. We look at the left-hand side in these regressions is basically how much you emit in foreign countries. And we're going to have fixed effects for foreign country times year. Okay. So the variation is going to come, and we're going to control also for home country fixed effects. So the variation is going to come actually from variation over the years in your home country. Okay, so we're holding the home country fixed. We're holding all the foreign country times year fixed. So the variation comes from the variation here in the environmental policies at home actually come from a time variation in your home country. And what we find is that as this variation, as the environmental policies at home increase, you send out more of your pollution outside. So this is what we call the push effect. When we look at the pull effect, we find no evidence. So the pull effect is going to be the reverse exercise. We're going to fix the home country and year policies and ask, does the time variation in foreign countries, in the policies of foreign countries, actually matter for firms that are housed in the home country? And we find basically no effect. It seems that what's going on here is that it's about the push. We also look at governance, which is conference. What we find is that there is a negative association. I should say, how do we measure governance? We basically use what institutional investors use. It's a Thomson Reuters Asset4 database, and we use just the overall governance score, which basically is supposed to measure whether management acts on behalf of long-term investors or generate investors, investor long-term value. And we basically ask, do firms that are above the median, that is there a differential effect in terms of CR, in terms of the environmental policies? And what we find is that basically compared to compare above the median, below the median, they emit less at home and slightly less in foreign countries. Now,
sorry, Zahi, you have 5
yes.
minutes left.
5 minutes is lots of time. Thank you. So what we see here is that basically when there is a strong governance policy, they emit less at home. Obviously, this is open to reverse causality because this measure is based on includes also how you what's your emission policy. It's an ESG measure. But what's interesting is that it is focused on the home emissions. Even if you believe if you think it's a reverse causality, it has a different effect. It's much more impacted by the home as opposed to the foreign emissions. So maybe there is, if you believe in the reverse causality, then it's maybe even a story of window dressing. At home, you emit less, but you actually kind of, you don't care that much about foreign emission. You care, but not as much. The third and last mechanism that we test, but we don't find very interesting results, is basically look at pollution-intensive industries. So these are industries that, based on just these are EU statistics, generate the highest emission per their activity, revenues, or assets. So what you could see here is that so basically what we do, we just look at, it's quite you'd say that the first 6 are really, taking most of the pollution compared to other industries. So the idea was, if you're trying to design a policy that somehow targets CO2, you may want to start with the big polluters. I mean, there is little, if you have if you look at the bottom one, repair of motor vehicles or trading motor vehicles, just these are just just selling cars. Maybe there isn't much to do there. These are just parking lots with cars. You may want to put your efforts in the big polluters, for example, refineries or air travel. And what we find is that if we look at firms in the pollution-intensive industries, basically they pollute more, but basically they pollute the same in home, or pollute more in the same degree in home and foreign. So we don't see a lot of much of response or much of variation with respect to the environmental policies with respect to home or foreign. Okay, so let me just wrap up here. So we think that there is bad news in the sense that there is carbon leakage is real. There is evidence about more foreign pollution, more upstream pollution. We like a lot the idea of pushing. No, we don't find any evidence for pulling. And maybe there is a bit of good news that maybe strict policies are associated with a lower global emission. And the overall message is that we need more collective action, because it's almost like you have to somehow having stricter policies at home alone is not going to help. It's just going to push it away. Then I found for you this. It's kind of the message in if you do what's in the bottom left, you're going to get less pollution. Okay. This is what I had for you guys.
Right. Thank you very much, Dahi, for the presentation on Sunday morning.
Yep.
The discussant is Per Strömberg from Stockholm School of Economics. Per, you have 10 minutes.
Great. Let's see. Okay. You see my screen?
Yes. Can you do
great.
Screen? Perfect.
Okay. And you hear me as well?
Yes.
Okay. So great. So well, thanks to the organizers for letting me discuss this paper. Thanks myself. Okay. So I think this is obviously a very important policy issue. As the problem with climate change is that it doesn't matter where you emit your CO2; it has an identical effect on climate change. So even if we in Sweden have very strict carbon tax and so forth, if the Swedish companies just move their manufacturing to some country where they can pollute without paying tax, we have basically no effect on the climate change. So this is what is referred to as carbon leakage. Okay, so this paper is basically trying to find evidence of carbon leakage. Okay, so Zai went through all the results. I don't think I need to spend so much time on these, but basically the one of the challenges here is obviously has to do with data. They use these CDP data which I assume are basically driven by firms report how much CO2 they emit, and the reason they do it is basically driven by investors. So this is public firms that are sort of disclosing the CO2 emissions. And then I guess investors use them to decide, where they want to invest to take into account ESG in their policies. So what, and then they combine this with data on how strict the policy is, which is from the WEF or World Economic Forum survey, and then financial data. And then what they basically find is that, you know, if you increase the strictness of your domestic climate regulation, you see a drop of 29% in your home country emissions, but you see an increase of 43% in your foreign emissions. So this is basically a carbon leakage indication. And you see a slight drop overall in your total emissions. And then there are various other results that Zahi went through. So I guess, you know, one of the questions probably, you know, you have, at least I had just initially, okay, is it good news or bad news? Because on the one hand, you know, you do see a net effect on total emissions of domestic policy. So maybe you could actually declare victory there and say, even if this is a global problem, it actually does matter what you do in your home country, because there isn't at least complete carbon leakage. On the other hand, there seems to be quite a bit of carbon leakage, okay? Now, to my comments here, one thing that I think we need to think a little bit about is what we mean with carbon leakage and how it's measured in the paper. So I think at least one sort of very intuitive way to think about carbon leakage is, okay, so I start, you know, there's two countries here, okay, so I have some dirty establishment and I have a cleaner establishment at home. You know, here's my my production facilities maybe and my sales facilities, and then my home country tightens CO2 policy. Okay, so to avoid whatever CO2 tax, I just move my dirty production to a country that has more lax policies, and I really haven't reduced total emissions a lot. Okay, so this is sort of what we're after in the paper, and I guess the results, some of the results are consistent with this behavior. However, there are other things that could happen as well. Okay, so take the following example. So remember that the dependent variable, what we're looking at here, is you know, one of the variables looked at least is percent of emissions that you do abroad. Okay, so take the following situation. Okay, before emissions, you know, a dirty establishment both home and abroad. I'm a multinational. After tightening, I clean up my domestic, you know, establishments, you know, where I sort of have to do it because I'm facing carbon tax, for example. I don't do anything to my foreign ones. Okay, so at least in one of the measures they're using, percentage foreign emissions would go up in this case, but I wouldn't probably call this carbon leakage because I've actually have reduced my my domestic emissions. Now you could say, well, but you know, they also look at total emissions, but then you have another issue, I guess, which is take this this issue, same thing as before. Okay, so after this tightening of regulation, I clean up my domestic businesses, and the firm is also at the same time growing. Okay, so here you would actually have kind of both the percentage and the amount of foreign emissions going up, but I'm really becoming a cleaner company. Okay, so it's going to be very important to sort of control for these things. I think more generally, you know, people or researchers in environmental economics have thought quite a bit about how to sort of think about changes in emissions. Just copied an equation from a paper by Levinson. So, you know, if you think about total pollution for a given firm, okay, you can think about that as, let's say they have establishments in a couple of different countries. Okay, so you could decompose this basically into this last thing here, which is, you know, it depends on your total scale and how much how big you are. It depends on how much you're producing relatively in different countries, and it depends on how pollution intensive your business is in these different countries or industries or whatever, right? So you could increase emissions because you grow, because of scale. Conditional on scale, you could change because of different composition across countries, across business lines. And you could, and this I guess is what we're after, if we want to get a cleaner world, you could reduce conditional on composition and scale, you could actually reduce emissions because you use better technology. And in the paper currently, I'm a little sort of confused about which one of these it is, right? So if you find that the foreign emissions increase, is it because you move dirty production abroad, which is, I guess, what we would call leakage? Or maybe you're growing faster in countries that where you happen to have dirtier divisions. Okay, so then I don't know if we call that leakage or not. Maybe you chose to invest more in those countries, in which case maybe we can call it leakage, but maybe it's just because that market grew faster. You could actually be improving your technology more at domestic plants, plus you grow overall, which was the last example I showed in the picture, and that I definitely wouldn't call leakage. Okay, so I think I would push the authors to try a little bit to think about decomposing the effects in this way. Now, one of the challenge, and I'm very sympathetic, by the way, that this is, you have the data you have, and the data is interesting, but it's not perfect, and you can't do a perfect sort of identification, QG type exercise here. However, let me just point out some things that are a little problematic. So these surveys, the emission data comes from these surveys that are basically pushed for by investors, as I understand it. The coverage has increased a lot over time. Okay, so this is really a very highly unbalanced panel. It's very unclear to me how the composition, to what extent these decreases in emissions on average come from different industries being included, different countries being included versus actually reductions. And then if you look to the right, even if you had a panel, there isn't so much going on, at least if you look at the averages of changes in policy over time. So there's not a ton of power in doing sort of a diff and diff, even if you had a perfect panel here. So I think doing a proper diff and diff here is challenging. And that also means that these regressions can't have firm fixed effects in it. You try to do the best you can to control for firm characteristics and so forth, but we're not talking about within firm changes necessarily in these tests.
Sorry, Per, you have 1 minute left. 1
minute, okay. So then I do think that this is sort of along the same lines. I think we're interested in emission intensities here. Are you sort of investing in using better technology? Is there, so trying to do more on that, I would encourage you to do. I think you mentioned scope 1, 2, and 3 emissions. I think the scope 1 emissions is really the one that's sort of informative in this exercise about what the firm is doing. Scope 2, you have a problem. That's basically the energy you're using. It could simply be that if you have a change in policy in the country, that affects actually the utility firms and what kind of electricity they offer, which will then change the scope 2 emissions of a given firm, but not because they did anything, it's because their suppliers of electricity were forced to do stuff. Scope 3 is interesting in principle, but data is very poor. One thing to also note here is that your results that there is not much reduction in pollution intensive industries is a little sad, because it turns out that the pollution intensive industries, 7% of the firms here account for more than 50% of emissions. So that no action in pollution intensive industries is actually pretty bad news. Final thing here that I do think is somewhat important on these country firm year level regressions, there is a tendency of strict policy firms up here in the right-hand corner to be quite small countries, and a lot of the large countries, this is now emissions, but I think it correlates pretty well with the size of the market and the size of sales in these countries. You see a lot of the big markets tend to be dirtier, and a lot of the small markets tend to be clean. And that's a problem if you think about these, Sweden has a stricter policy. At the same time, if Swedish firms are growing, they kind of have to grow in these dirty countries because that's where they can sell stuff. So I think you potentially could have some spurious relationships there. So anyway, that's my comments. Sorry for going over a bit. I think it's an interesting paper, definitely on a very important issue. So I think I had more patience with methodology since the issue is so important. And there are a lot of data limitations that restrict what you can do, but maybe there's some more things that you can do here. Final word is think about colorblind people who can't distinguish red from brown like me. But anyway, that's what I had.
All right, thank you, Per. Zahi, would you like to respond? And then we have some questions from the panelists. Maybe we can take those from David.
Yes, all right. So thank you very much, Per. I well appreciated and our good comments. I don't have an answer to all of them, but it definitely gave me some ideas of other things we could do. So, for example, you mentioned the growth, maybe uneven growth between domestic and foreign. So one of our variables that we have that we maybe could use is the percent of foreign assets. So maybe we could do something with that.
Do you have sales by country or only assets?
No, only assets.
Okay, that's too bad. Because I guess there's some interesting differences between sales and assets.
No, and I think in many of these are the production facilities. Think about cars, right? I mean, so the production is done somewhere else. The assembly is the design is. I mean, each country has its own kind of.
Yeah. So if you had country level sales as well as country level assets, you could actually directly see if it's due to outsourcing of manufacturing facilities versus just different sales in those countries.
Yeah, as far as I know, we don't have this. Probably there is something we could do to check at least whether the unbalanced panel is responsible. Maybe there is something about weighting by country, kind of evaluating, just to check whether there is anything spurious going on there. Yeah, but these are, I mean, the composition I think is something that we probably could do more. And to some extent, I think we do have some results because we see the change in the domestic, the change in the foreign, and the change in the percentage. So we could probably do more in terms of interpreting these results. There are some questions in the I see in the chat here.
Yeah.
Do you want me to answer these, or what should I do?
So I think David has a question. So maybe we can go with David's question first, and then maybe we take the other questions privately.
Okay, hello everybody. So my question was, I mean, that kind of leakage can happen within multinationals, but I would imagine it also happens, across firms. Like, I'm, having, another firm I'm importing from. So instead of having my own factory that is dirty in my country, I will use, another company to basically buy the, which I'm gonna buy the goods from, that is in a, kind of in a dirty country, or that is a dirty company abroad, and that you could check by using sort of the same data at the country level. No, if I'm in a country, so is it the case that I see an increase in pollution in countries that tend to export to countries that have an increase in their regulation of environment or something like that? That would be like a sort of the same regressions as the one you run.
So this is really the scope 3 that we have. So the scope 3 is how much the pollution that went into my inputs.
Yeah, but you could do it using other. What I'm saying is that you don't even need your WEF data. Is what I'm saying. You could do it with trade data.
Right, and so maybe there we should do a better job in relating to the literature, because with trade data, we're not the first ones kind of thinking about this idea of leakage, right? I mean, there is a 20-year. Sorry, maybe I should have again. So there is quite a bit of literature about carbon leakage, but the carbon I should have done. I'm sorry. The existing literature looks at exactly what it looks at FDIs, looks at trade imbalances. Everything is at the aggregate level. There's nothing at the firm level. There's no firm level information.
Okay.
Oftentimes, CO2 is CO2 is approximated by the amount of industrial output, for example, as opposed to kind of actually measuring CO2. So the advantage here is really the data. It's CO2 and firm level. That hasn't been before. I should have. It's a bad.
But you still have an issue of sort of, okay, are you decreasing CO2 because you're sort of shutting down operations and we can't grow anymore, and then are maybe other firms picking up that slack and so forth, right? So that's, I think, is also along the lines, depends a little bit on competitive pressure and so forth. If we kill off all the Swedish firms, steel firms, and then the Indian ones pick up the slack, have we really done much for climate and so forth? Which I think this other literature is also.
Yeah. So maybe there is something more to do in the aggregate. And then we again, if we look at aggregate, the issue of unbalanced panel is really important, because we're aggregating across different terms. Yeah. I mean, I need to think about how to address this. Thank you so much.
Thank you very much. So in the interest of time, I suggest that we skip the break and go directly to the second paper. And there are some questions in the chat room. So if the authors of the first paper could chat and respond privately, that would be great. All right. So the second presenter is David Thesmar from MIT. The title of the paper is "Do Investors Care About Corporate Externalities? Experimental Evidence." David, you have 30 minutes. The floor is yours.
Okay. Thank you very much, Dong. So you can see my screen. You can see the mouse also?
Yes.
Okay. Okay, so this is, as you said, a paper. This is an experiment on that tries to test whether investors care about corporate externalities. It's joint work with Jean-François Bonnefon from Toulouse, Augustin, and Sastry from MIT. So the debate this is coming from is the debate that has been discussed already several times in this conference on stakeholder value, where I mean many people have called for firms to maximize something else than shareholder value. So from Elizabeth Warren to Robert Reich to even the CEOs of the business, a round table in between the lines of their declaration. And then for these people, obviously, maximizing shareholder value, if you try to maximize stakeholder value, you cannot really maximize shareholder value simply because kind of the reasoning goes, shareholder value is the sum of future dollar profits of a firm, and it excludes, shareholders' social concerns. Okay, so it excludes kind of private benefits that shareholders would derive from the company doing good. Yet, if shareholders are altruistic, actually their pro-social preferences may affect prices. So it should be reflected somehow in the price that shareholders actually do care about something else than just dollars, simply because stock prices are not profits. Stock prices can be a vote of confidence for the firm. It can be a way to owning a firm that does good can be more than just the claim on dividends, while owning a firm that pollutes can be less than the claim on dividends. So that's the way preference for corporate social responsibility has been modeled in various papers. I'm not even sure I have all of them here, but since the early 2000s, until recent papers by Pedersen, Pastor, and Stambo, that, you know, when you own a stock, typically what you own is not just a claim to future dividends, but also, you know, private benefit that comes from, you know, how the firm is behaving and how you judge the company is behaving. It's also the intuitions behind social stock exchanges, where social enterprises, the stock of social enterprises, which are like essentially companies that are not trying to make money, I mean, they're making a little bit of money, but that is not their primary goal, can be traded. Okay, and there's also indirect evidence that shareholders actually do care about not just, you know, dividends, dollar dividends, but also how firms behave, from even studies and even recent paper by Hartmann and Thesmar, which is on mutual fund holdings. So, which is an investor holding of mutual fund shares. So there is indirect evidence, but nothing really direct. But, you know, that's kind of something that's everywhere in models and everywhere. So basically in this paper, what we're trying to investigate is why and how investors' social concerns are priced. Okay, so we're gonna start from an experimental paradigm where it is priced, as you will see. And basically we're gonna ask what are the channels through which investor social concerns are priced. Okay, so let me, before I explain a little bit more what we do, let me just, you know, unroll a few hypotheses of how investors' preferences are channeled into prices. Okay, what drives the pricing of social preferences? So one possibility is simply something that's being discussed in the literature, in particular by this paper by Stu Gilson and others, but, you know, in other papers too, which is impact investing or value alignment. So impact investing is very much along the line of the paper that Augustin presented yesterday, where basically by owning a firm, by conditioning your investment in a firm onto this firm's good behavior, I mean, that's what you want to achieve basically by investing in some firm. So a firm is polluting, and you're gonna tell the firm, okay, if you pollute less, I'm gonna give you money, or I'm giving you money under the condition that you end up polluting less. So that's kind of impact investing. So you buy the stock of the firm to change it. Or value alignment, where basically you don't really care about your own impact. You don't think you can have an impact on the firm, but you want to reward some of the firms for their good behavior in a sense. And that kind of goes back to different kind of preferences, moral preferences. Like is your moral preference unconditional on what you can do, or does it depend on, you know, on your actions? Another discussion that is often made is simply, I mean, going back to the Friedman 1974 New York Times op-ed, is the idea simply that, you know, pro-social investors may price pro-social preferences because these are not the pro-social preferences of these are not really the preferences of the end investors, but really of the mutual fund managers that are investing other people's money. So it's about doing good with other people's money. So it's just, you know, the price of high ESG rating firms is simply high because asset managers want to feel good about themselves. Another channel that we can also discuss is the Hart and Zingales argument about the limitation to Friedman's argument, which is that, you know, Friedman says essentially, if I own a stock of a company that donates money to schools in Africa, I don't really care about that because I can donate money to schools in Africa myself. So the company has no particular comparative advantage at achieving that purpose of donating money to schools in Africa. But there are situations in which, you know, companies have a comparative advantage. For instance, it might be very hard to capture CO2 and to, you know, put it back from the air into the ground, but not polluting in the first place is kind of an easier way to fix that. And so maybe, you know, as I would want to own the stock of companies that do well, or, you know, invest in those companies in order to because companies have a comparative advantage at implementing the first best that I want. And then also your channel that matters is also the clarity of firms' pro-social behavior. And in a sense, you know, that relates to the debate on greenwashing, CO2 offset programs. So greenwashing is really like, we don't really know whether the company is actually doing good or not. And the offset program is more like, the company at the same time emits CO2, but at the same time it buys carbon credit in order to, basically have an impact, a negative impact on CO2 emissions, and it's kind of its own moral attitude is unclear. And so does it affect, investors' pricing of pro-social preferences? Okay, so basically testing this hypothesis is hard in the field, simply because prices typically conflate profit reducing CSR and profit increasing CSR. So that's a well-known problem. That when a CSR decision is announced, it's not clear whether it's going to increase profits, in which case prices could go up, or it's going to decrease profits but increase kind of the attitude of the firm, and therefore generate a positive reaction also because simply people like it. And it's also hard to isolate those different channels. So that's basically for these two reasons that's why we're running an experiment on 1,500 participants. So it's a fairly large scale experiment that allows us to investigate these hypotheses. So before I go into the details, that's the experiment design in a nutshell. I'm gonna get more into the details, but that's the experiment in a nutshell. Basically, participants are presented with stocks, and those stocks pay a cash dividend pi minus C, and they give C to a charity. Okay, so as a participant, I can buy this stock. Okay, so pi minus C is a value, C is another value. Okay, so pi is basically the profit of the stock, and some C is given to a charity. And participants are asked to bid for these fictitious stocks. So then what we investigate, the empirical object we investigate is this beta right here, where across participants, what we do is that we compute this thing here, which is called which we call the excess bid. So that's the bid of the participant above and beyond the cash dividend of the stock. So it's kind of the extra value that the participant attaches to the stock. That's due to the fact that the stock is paying some value C to a charity. And basically what we ask is whether this excess bid is sensitive to how much the company is giving out. So if beta is 0, then people are Friedmanian, they just value stocks as equal to the cash dividend. If beta is more than 0, then people value somewhat the donation. And if beta is 1, they really value $1 of donation as $1 of value. Okay, so that's kind of how the donation is translated into value. So we call beta the pass-through or the altruistic pass-through. And basically, we explore how beta changes across various conditions. So going back to the channels I've discussed earlier, we're going to discuss impact investing versus, versus value alignment by asking whether, a successful purchase changes the firm behavior or not in our experiment. We're going to ask whether participants can donate directly themselves, in which case, the comparative advantage of the firm to donate is basically less because now participants can donate themselves. We're going to ask whether participants invest their own money or they invest another participant's money. That's to test the moral hazard kind of thing. And then, we're going to vary also the clarity of the firm's pro-social behavior by, introducing uncertainty. That's the one thing. And the second thing is basically by having the company donating to a charity and taking money from a charity at the same time. This is all actual money, so I will show you how it works, but that's kind of the idea. So basically, we're going to see whether, these conditions affect the altruistic pass-through. And so basically what we find is very simple. It consists of, so first in the paradigm, whether firms give away to a charity or not, has actually a fairly high pass-through. So that's indeed people price, good behavior. Bidding is overall consistent with deontological preferences in the sense that it's independent of impact. It's independent of whether I'm managing my own money or not. It's independent on whether the company, whether I'm allowed to donate my own money or not. It looks like a vote of confidence in a sense. It's kind of the company does good, price is going to be high, company does badly, price is going to be low. That's what seems to be happening. And of course, clarity matter, but in a simple additive way, in the sense that, you know, people value an expected charity donation exactly the way they value a certain donation. Basically, it's the same path through. It's 0.8. And if a company, you know, gives $1 to a charity, takes $0.5 from another charity, then, you know, people value this as 0.8 times 0.5, which is 1 minus 1, 0.5. Okay, so that's consistent very much with, you know, with the models that I've discussed in the previous slide, you know, the models that have been written, and also, you know, you can easily build some kind of portfolio theory with private benefits, in a sense, as part of the portfolio returns. So I'm gonna, in what I have left, I'm gonna describe the experiment and go over a few results, perhaps not all of them, but you feel the spirit of what I have. So let me describe the experiment first, okay? So we recruit 1,500 people on MTurk on 5 consecutive batches. Some of them are in 2019, some of them are in the summer of 2020, you know, after the pandemic, but, you know, it's reasonably, I mean, their answers turn out to be reasonably reliable, as I can discuss later if you're interested. And participants, each participant is asked to value 3 stocks. So that's going to be 4,500 rounds, a bit less, as you will see in a second. So we're going to about 4,000, you know, rounds of stock valuation. So that's, you know, reasonably sized data, where basically they're presented in a random order with 3 stocks: a neutral stock that does not donate anything to any charity, so it's just a pure profit; an ethical stock which donates some of the pie profit to a charity; and an unethical stock, which is essentially, you know, taking away money from a charity. I will explain to you in a second how that works, but essentially, you know, it's kind of to simulate also the polluting stocks, you know, as well as good doing stocks. And valuation is measured through a standard bidding mechanism in the experimental literature, whereby basically it's a second price auction with a machine. So the participant bids B, the machine draws a random, you know, price, and if the participant wins the auction against the machine, so if the participant bids more than the random machine, the participant pays the price, the random price to own the stock, and then, you know, upon owning the stock, the participant gets pi, and C may or may not be given to a charity. And it's well known. It's a well-known algorithm. It turns out to give good results, as you will see, etc. So that's kind of, it's totally standard. So now let me just describe a bit more in detail, but that's kind of the idea. So so you define. We initially. So how does it work? Like sequentially. So first we defined 2 wallets with initial endowment. So the participant is given $2. It's $2. It's actual money. So the participant is given $2 of money, and the charity is given $1. Why do we have a charity wallet? It's to implement the pollution thing. So basically, whenever the company is going to be an unethical company, money is going to be taken from the charity wallet. So that's money that we as experimenter pledge to give to the, you know, to the charity, but, you know, that money is going to decrease if upon the appearance of the unethical company. And participants, so it depends on the conditions. It turns out to not matter, but there are 6 charities that kind of span the space of causes, from children to food to development, etc. That in some conditions the participant can pick. In some other conditions, it's just randomly chosen. It turns out to not matter actually, not that much. We then provide, before they actually start doing the thing, we provide them with a simple example of BDM bidding. So Jean-François, who's the psychologist of the group, was very afraid that people would not get it. And so basically we describe how that works, in an example with a step-by-step explanation of the effect on both wallets. And then something that we believe is very important and we're very happy with, a very good, I don't know that it's an innovation, but at least it's something that that gives us a lot of confidence in our results, is that we have a practice quiz. So the practice quiz makes sure that all consequences are understood. So before we actually went to the practice quiz, we actually ran a first live test in the lab. So Jean-François sat with physical participants and could see that, you know, whether they were struggling and where they were struggling. Then we ran a pilot survey to make sure that, you know, people understood the thing. So it was not really an experiment. It was just checking that people understand what happens, you know, sequentially. And then basically we set up that practice quiz that we embed in the experiment, where there are like 2 examples where people are presented with one ethical and one unethical firm. And then, you know, they have a successful bid, a failed bid, and we ask them to forecast what will be the impact of these bids on both wallets. And they cannot proceed unless they ace the quiz, and they have 3 attempts max. Okay, so we're sure that the people that, you know, the data that we have is from people that understand the consequences of their choices. They really do understand. Yeah, that's it. Okay, so they really do understand. So then we have 4. So then we proceed to the actual experiment if you pass the quiz. So there are 3 bids, as I said, because there are like 3 companies that are presented in random order. It turns out that the order doesn't matter that much, but it's just to control for priming, for the sequence, you know, that might matter. And profits are drawn randomly. Charity donations are drawn randomly, you know, from $0.5 to $1 for profits, from $0.1 to $0.5 for charity donations. It's drawn at random. And then we recap the final amounts on both wallets. Okay, so that's the idea. So then, of course, we have the various conditions that we need in order to test our various channels. So besides the baseline, we've got the one with impact. So the one with impact is very simple. It's basically about saying, okay, the charity wallet will be affected if and only if the bid goes through. Okay, so if I manage to buy the company, then the charity is going to get money. If I don't manage to buy the company, then the charity is not going to get money. Okay, so that's kind of the impact condition. And the baseline condition doesn't have that. In the baseline condition, whether I buy the company or not upon my bid, it doesn't change, you know, it doesn't change anything as to whether the company receives something or not. So it's kind of what we call the impact versus, you know, value alignment kind of condition, basically. And where one condition, you know, whether I buy the firm or not doesn't matter. On the other, it actually affects, you know, whether the company, the charity receives money or not, or is taken money from or not. So that's the impact one. Then we just allow people to donate directly at the end, and we warn them in advance of that possibility in kind of the comparative advantage condition, where basically so in the baseline condition, they're not allowed to donate. So maybe that's why, you know, they kind of, you know, they may tend to overbid for firms simply because, you know, that's kind of the only way to donate in a sense. So we allow people to donate directly at the end. There's the moral hazard condition where basically we implement some kind of delegation game where they're told that people that they're not managing their own money, but the money of another participants in the list. And they are actually, because it turns out that the wallet that they have at the end of the game is given to, you know, the next participant on the list. So it's really they're really managing someone else's money. We make sure in the quiz that they understand that it's not their own money, but the money of someone else, you know, so they really understand. So in the quiz, we're sure that they understand, otherwise they don't pass the quiz, they don't participate. And then we implement, you know, the random donation, you know, so there's a toss of a coin and, you know, the charity may receive $0 or $0.50. And same for the second, the ambiguity condition, where basically at the same time, the company implements a positive and a negative donation, you know, so that's kind of, you know, so we have those different things, and we end up with 4,100 rounds of bidding. What are the results? So I have how many, how many minutes do I have? I can't hear you. Okay, I can't hear you.
That's sorry, okay. 9 minutes, sorry, yeah.
9 minutes?
Yeah.
That's great.
8:30.
Okay, so first, what the, so the paradigm in general, like kind of the experimental paradigm in general, kind of achieves sort of the baseline fact that we care about, which is that, you know, donation, like non-direct dollars are actually priced in those bids. So essentially, so that's kind of the key thing. So we run that regression, which is on the cross-section of our results, of our experimental results. On the left-hand side here, you have what we call the excess bid, which is the bid minus the selfish dividend, or the dollar dividend that the company, that the stock is paying. Okay, so the spread, so sort of, you know, the excess bid in addition, in excess to the dividend, on how much the stock is donating. Okay, and basically the sensitivity here is the pass-through, and that's the result here. The graph here that you're seeing is just the result of that regression. Okay, so it's the average excess bid per charity donation. Remember, charity donation is discrete. Okay, it goes from minus 0.5 to plus 0.5. So it's fairly linear, and you know, the constant is almost 0. I think it's fine to consider that it's 0, and beta is 0.8. So essentially, each dollar of charity donation gives rise to an increase in the price by 80 cents. So that's kind of, you know, it's a fairly high pass-through, which is good for us because we want to make it vary. So it's good that we start with a high pass-through. And interestingly, it's symmetrical, completely symmetrical. So if a company donates $0.50 to a charity, the price is going to be 0.8 times 0.5 higher. Okay, so 0.4 higher. If a company takes away $0.50 from a charity, then the price is going to be 0.4 lower. Okay, so it's kind of, it's the same, it's symmetrical really. Okay, so now let's try to investigate the channel by basically changing, you know, the conditions. So the first one is impact. So basically, remember there are two. So here in this graph, in this table, there are two columns. Column 1 is the baseline. Okay, so it's the base. It's not all of the data that I showed you before. So it's just, you know, it's just the corresponding baseline here. So you have indeed that every dollar of charity value generates an excess bid that is $0.8 higher. Okay, so that's column 1. And then in column 2, what you have is the corresponding condition. So where, like, you know, where people were subject to the same, you know, with the same people in the same experiment, the same batch, where people are now told, and we check that they understand, that the charity only receives money whenever the bid succeeds. Okay, if the bid fails, charity doesn't get money, or if the bid fails, charity is not taken money from when the C is negative. And here we see exactly the same path through. Okay, the test, the p-value of the different tests is very large. So essentially, what we're seeing here is that it doesn't matter at all whether the charity is actually going to get the donation or not. If my bid is successful or not, I really want to basically reward firms for good behavior in a sense, and that goes in favor of kind of the value alignment view of ESG investing over the impact investing view in this particular setting, at least. Remember, we quiz participants to make sure that they understand the difference that is kind of, you know, that they're pivotal in the second experiment. Okay, then we test comparative advantage. So here we're comparing two conditions. One condition, it's actually slightly different from that, but you know, that's fine for presentation. So here there are two different conditions. So condition 1 is where is the baseline, and condition 2, so the second column, is a situation where people can actually donate themselves. Okay, so they can donate money. So whenever they can donate money, actually, so if we believe that, you know, whenever the comparative advantage of companies to actually do good disappears, the excess price of good doing companies should go down. We don't find that at all in the data. Okay, so here the sensitivity is the same. Whether the company has a comparative advantage at donating versus not. So that's again, you know, kind of going in the direction of saying it's a vote of confidence for the company rather than just, you know, a way to donate. You know, it's really just it's a vote. It's the company is doing the right thing in a sense.
David,
So
sorry, you have 3 minutes.
That's good. Moral hazard, I have 3 tables to show, so that's perfect. So moral hazard now, so moral hazard does not drive pricing. So here I'm comparing the 2 conditions. So the conditions where people manage other people's money and the condition where people manage their own money. So again, here I'm showing the two beta parameters here, the 2 pass-throughs. So it's true that the pass-through under delegation is slightly higher, but not significantly so. Okay, so the p again, the p-value is fairly high here. So I still tend to overprice, good doing stocks a lot, even when I'm managing my own money compared to when I'm managing other people's money, in a sense. And I don't even see a difference here. There's a slight, positive difference, but it's not significant again. So managing other people's money does not seem to make participants bid significantly higher. And now the last 2 conditions, which pertain to clarity of ESG behavior, of CSR, of socially responsible behavior. So the first one is basically by comparing certain. So column 1 is a certain donation. So donation is certain. It's going to be $0.5 given to charity X. Column 2 is uncertain. So again, there's under one. So I'm going to toss a coin. We have a coin that flips, and we have a picture with a coin that flips. And then we tell them, okay, you can have the positive or a negative charity value, and we don't know which one it's going to be. And so basically the regression we run here is the excess bid on the expected charity donation here. Okay, and what we find is that the pricing of the expected donation is the same as the pricing of the certain donation in the baseline condition. So in a sense, uncertainty affects pricing, but really in a way of taking the expected value of charity of charity donation, really. Same for ambiguity. So now ambiguity is the one where the company at the same time donates and takes away. Okay, and here we have this number, which is the net donation. Okay, on which we regress the excess bid. And again, what we find is that the coefficient on the excess bid tends to be the same. There's a slight difference here, so I mean statistically, but it's barely significant. So I guess the takeaway is that there's not much difference. If the net donation has the same effect as a certain single donation to a firm per dollar of net donation, in a sense. So again, ambiguity affects pricing, but in a very additive way. So the bottom line is this. In our experiments, corporate donation is 80% priced. Okay, that's not due to confusion. We check with a quiz. Such pricing is consistent with deontological preferences, okay, independent of impact, of moral hazard, of a comparative advantage. So not on impact, but really, it really seems to be a vote of confidence for the firm. Of course, uncertain or ambiguous CSR is going to be priced in, of course, if it's not less than probability 1 that the company is going to do good, the price is going to be lower, but in a way that is completely additive. So the consequences are twofold. First, shareholder, but I won't be insisting on that because the authors don't really agree on this. But the second point is really the one that I want you to take away, is that it's possible. So people behave kind of deontologically. And second, it seems possible to extend standard portfolio theory, which is with cash dividends, to non-pecuniary benefits for stocks, basically. You can add the non-pecuniary benefits and assemble stocks together in a coherent portfolio, and that will give you the equivalent of a single firm. And that's it. Thank you.
All right. Thank you very much, David. The discussant is Enrichetta Ravina from Northwestern. You also have 10 minutes.
Okay. Yeah. Can you see my screen? Yes. Okay, so thank you very much for inviting me to discuss this paper. I found it very interesting and actually very topical as well. So I'm going to summarize very quickly the paper. David did an excellent job in presenting it, so we don't really need it. So the question of the paper is, do shareholders value ethical behavior in firms? And if they do, how much are they willing to pay for it? And what is exactly the mechanism that induces them to pay that much? They run a lab experiment to answer this question using 1,500 subjects on mechanical Turk. And the advantage of a lab experiment is that it allows them to abstract from a lot of things that are going on in real life and focus on this mechanism. The paper and the presentation are slightly different, but I don't think it will matter. So there are 5 treatments. 2 treatments are such that you cannot donate in the end. So if you want to reward the company that is ethical, the only way you can do it is by paying a higher price for it. And you can do it either in a baseline setting in which the company will receive some donation, regardless of whether you end up buying the stock or not, or you can do it in a setting in which you are quote unquote pivotal, meaning like, maybe pivotal is not the right term. It's a setting in which the charity is given to the company only if you actually buy the stock. So there are a lot of people, and maybe you are atomistic, but you do your small part in giving money to this company. And then there is a donation setting in which, in addition to paying more or less for an ethical company, at the end of the experiment, out of your profits, you can also take part of it and give it to the company. So what they find is that subjects are willing to pay about 80 cents for every dollar that is donated to charity. And this effect is linear, meaning, it doesn't matter if you double the amount, you double the willingness to pay. And it's also symmetric. It's the same type of relationship when we talk about unethical firms that take away from charity. One other thing that it's interesting is that being pivotal or investing on behalf of others doesn't change the valuation. And finally, the possibility of donating to the charity at the end doesn't seem to affect the behavior and the pricing as well. And this, I thought, is a little bit in line with the Milton Friedman idea of, we would really like firms to maximize their profits because as shareholders, we could always take part of those profits and give it to a firm. And here, the subjects don't seem to think that way. And maybe it's the setting, or maybe this is an idea that is not intuitive in real life unless you explain it to people. But it doesn't seem like that people say, oh, I just go for the maximum profits and then I can distribute money myself later. Okay, so these are my comments. First of all, I like the paper very much. It's great that we have the possibility of doing lab experiments because they help us understand the mechanism that too many confounding effects in real life. Of course, I'm the discussant, and so I will have to also say something more critical, hopefully constructive about the paper. So one question that I have, one issue that I have is the sample selection. So the workers on mechanical Turks tend to be lower income, maybe younger than the typical investor. And even controlling on age and income, it's possible that they are, let's say, unobservably different. They might have different preferences. There are a lot of papers that say that studying economics makes people less charitable, more greedy, more likely to want to free ride. Even just priming them for their profession, like in the finance sector, makes them less compassionate. So one question that it would be interesting to address, and maybe the authors know, I think they know who invests in the stock market and who doesn't. Maybe they know the occupation. It would be interesting to see if you are primed or if you are in finance or economics. Are you more profit-oriented and are you less, quote-unquote, deontological in the way you address these companies? Another thing is the stake. So maybe in lower stake settings, people feel like they want to reward charitable companies, but when it comes, for example, to their 401k or managing large endowments or mutual funds, then they think about profits more. So this is one critique that is always true in experiments, and maybe if you have time and if you have the resources, you could see if increasing the stakes generates a different type of behavior, or there is still the same effect. Finally, for this page at least, I have a question also about the way the quiz is set up. So the authors should be commended because they make really every effort possible to make sure that their subjects understand what they are doing. They check and they exclude those that don't. And one thing that I wonder is whether the way the quiz is set up might create an anchor or a misunderstanding in the experiment. So if you look at the quiz, the ethical company has a profit of 1.5 and gives to charity 0.4. So that at the end of the day, you as an investor end up with 1.1. The unethical company gives has a much lower profit, 0.7, takes away from the charity 0.4, so you end up with 1.1. And I wonder if this, and maybe my reading of the paper, but I wonder if this leaves people with the impression that charitable companies are also companies that have higher profits, that all else equal, you know, you end up more or less with the same amount, 1.1. So you might as well give to charity then. And this is a possibility. Finally, statistical power. The authors don't find that a lot of the treatments are significant, delegating, for example, having an impact, direct impact on how much money the charity receives. And I wonder if that is due. Economically, the two coefficients are slightly different. Maybe even if you look out of $1, they are maybe significantly different, but they are not statistically different. And I wonder if, you know, there is a way to add more subjects to each of the arms and see if we can separate those. Maybe we cannot. Possible extension. So I think one thing that it would be interesting to see is since the demographics for these people are available, is to understand how the distribution of the preferences relates to the demographics. Is it true that millennials, for example, are more likely to give to this type of company? Like, you know, it's at least the word on the street that that's the case. Democrats, women, are there any differences, and are these preferences measured in the lab line up or tell us something different than what we think goes on in reality? Then what happens when we put these people in context? And so I think an interesting extension would be to see what if I have to pick what if I have to decide whether I want to give money to a tobacco company that also does a lot of charity. You know, they do greenwashing. How do they react? Is the $1 of charity worth the same, or is it less? Do they really care about giving to charity, or are they rewarding the company and their business per se? And what happens when, you know, it's more difficult to understand how much of the money that you give, quote unquote, to the company by purchasing the stock actually goes to CSR. And here, I think the authors with the clarity of like treatment are already going in that direction. Finally, I think it would be interesting to see what happens when other people can observe your actions. So, or whether you can sort of signal you being good for, you know, to others. Would you be willing to pay more or less? Would it matter across the different settings? And one thing that I thought it was interesting is also that it doesn't seem to matter what type of charity you are donating to. So, which is maybe it's real, maybe it's just the donation itself, but it seems counterintuitive. Maybe some people care about the environment, but really don't care about children or something else. And so it seems that they should sort of be more likely to give to certain causes than other. And maybe the correlation between these preferences, the demographics will tell us something as well. Like the charity that you got, depending on your demographics, were you more or less willing to give?
Enrichetta, you have 1 minute.
Okay, perfect. So this is basically the last slide. One question I think that is results, you know, at least may come to my mind is that, so now that we know and we have this measurement and these results, either qualitative or quantitative. What can a company do then to maximize share price? What should you tell people? What should you do? Is it worth it to give to charity? One other thing related to this, it seems that the preference for corporate social responsibility are very strong in the lab. Maybe, well, it's difficult, like the author points out, to really pinpoint this mechanism in real market, but they seem quite strong. And I wonder why. What are the features that in real life dampen this effect? Maybe we don't trust that the companies are giving to charity. Maybe we don't realize, or it's not the most salient thing that they do. What else is going on? Other comments we can talk about later. So to conclude, this is a very important and interesting question. How do investors value CSR? And the authors designed a very clever experiment and found interesting results. It's definitely a paper worth reading, and I look forward to read the next version. Thanks a lot.
All right, thank you very much. David, would you like to respond to the discussion?
Yeah, but just more like, because it was a very thought-provoking discussion, so it's very, it's not really response, but reactions to the reactions. Thank you very much, Enrichetta. It's great. Please send us the slides. Just a few things. So on demographics, I agree. We should look at them again. My recollection is that we don't find that much. I think an interesting fact, and I don't know what it means, but I will just deliver it this way, just like this. We ran the experiment on 120 MFin students, so Masters in Finance students at MIT, from like various countries, mostly foreigners. I mean, not US citizens. And it turns out there is not that much difference. So they were not even playing their own money. So it was like fictitious money. And they gave very similar results, like a slightly lower pass-through, but I don't think it was significant. So in a sense, that's kind of a demographically very different sample, but it's not professional. I agree with you that why not having like higher stakes and professionals, why not? Something to think about. On having more detailed context, like having a tobacco company that at the same time is funding lung cancer research, for instance, that would be like the extreme thing. So how would you? So we could try that. The thing is, there is virtue in having a very stark, very simple context, and that may explain why actually we're getting like those very high pass-throughs in a sense. So maybe like if we start like feeding people with more information and having them like figure. So yeah, it's a good question. I mean, we have the feeling that we get more external validity by having a starker context, but at the same time, you know, I don't know, because if in the tobacco company example, depending on whether you're a smoker or not, like you're bringing in your entire like internal universe to the lab, and we want to try to avoid that. But I agree with you that it's not an obvious decision to make. The last thing is on the irrelevance of the charity. So whether like it's, you know, food for the poor or save the children, etc., it doesn't really matter whether you choose it or not. And, you know, so it's kind of, so in a sense, it means people don't have real preferences. It goes in the direction of the rest of the additivity results. Like, you know, like when you have like an uncertain, you know, donation, 1 or 0, people put 0.5. When it's ambiguous, like +1 and -1, people put 0 or something like this. And again, here you kind of add everything up, so it's kind of, it goes in the direction of saying we could build a portfolio theory of pro-social behavior, something like that. Yes, but yeah. Thank you very much, Enrichetta. Please send us the slides.
All right, thank you very much. So we are 4 minutes behind the schedule, but I think we're going to need a break. So let's take a 5 minutes break and we come back at 3:45. Thank you.
Thank you.